Ferrari unveiled the Luce on May 26 in Rome. In one trading session, roughly $5 billion in market value disappeared. The stock fell 6% on launch day, then extended the decline to 8% the following session. That is not a routine earnings miss reaction for a luxury automaker. Ferrari's market capitalization has historically traded at a steep premium to peers. The standard explanation is brand scarcity. Ferrari deliberately limits annual production to roughly 14,000 cars globally. That scarcity creates a waiting list, maintains resale values, and justifies a valuation multiple that no traditional automaker comes close to. The market accepted this for years, even as Ferrari added the Purosangue SUV, its first four-door model. What the Luce introduces is structurally different. This is not simply a new body style, it is a new audience thesis. Ferrari CMO Enrico Galliera stated the goal explicitly: the possibility to enlarge our Ferrari community. Those 5 words carry more weight than the 1,035 horsepower under the hood. Enlarging the community is the direct inverse of the scarcity argument. The market's 8% move is best understood as the price discovering that these two theses cannot coexist simultaneously, at least not without a new valuation framework. The unstated premise that Wall Street had been pricing was this: Ferrari's brand is terminal inelastic, meaning it retains its premium regardless of product category expansion. The Purosangue tested that premise. The Luce broke it open. Former chairman Luca di Montezemolo said the prancing horse from the Luce was preferable to keeping it. That is not a styling complaint. That is a thesis statement from the person who spent decades constructing the brand framework the current multiple depends on. The question investors face is whether the -8% move already prices in the full erosion, or whether it has only begun to discount the compound risk.
Ferrari's luxury multiple has one structural requirement: the buyer cohort must remain constrained. When demand exceeds supply, the brand captures pricing power on the primary sale and the resale market simultaneously. This is the mechanism that makes Race trade like a luxury goods company, not an automaker. Hermès does not expand its Birkin production to meet demand. Ferrari's analog has been identical. The Pugliese is Ferrari's first 5-seater. It is the most expensive Ferrari ever, at €550,000 in Europe. The price appears to protect the premium, but that reading misses the structural shift. Ferrari is not just adding a price point, it is adding a buyer profile. A 5-seat, 4-door GT is targeting a customer, wealth-preserving families, status-driven tech executives, who did not previously fit in a Ferrari. These buyers do not have the waiting list history, the marque relationships, or the model literacy that characterizes the current owner base. Ferrari's design choice reinforces this read. Love From, the firm led by Jony, was responsible for both interior and exterior. The interior has been described as an anti-Tesla: precision-machined aluminum dials, physical switchgear, Samsung-developed custom OLEDs. But the comparison itself is damaging. Ferrari's current holder does not want the car compared to Tesla in any dimension. The brand premium has never been priced against technology. It has been priced against exclusivity and racing heritage. When Ferrari's own design language invites the Apple and Tesla comparison, the brand is repositioning, whether management acknowledges it or not. The key analytical question is, at what order value does the Pugliese's revenue contribution outweigh the brand dilution cost? Ferrari's entire 14,000-unit annual production ceiling means the Pugliese cannot move revenue in a way that justifies ignoring the multiple compression. If the Pugliese expands the community at the cost of the scarcity thesis, the premium must reset to a lower equilibrium. The competing frame, held by the analysts or called the drop by the dip, requires a different premise, that Ferrari's premium is not scarcity-dependent but performance and heritage-dependent. Under that premise, 1,035 horsepower and the Jony EV designed house are additive, not dilutive. That premise requires the new buyer cohort to be absorbed into the existing premium, rather than repricing it downward. History does not offer a clean comparable. Porsche's Cayenne expansion is the most cited reference. Cayenne revenue expanded Porsche's total without destroying the 911's pricing power. But Porsche's brand premium was never as tightly anchored to pure-play scarcity as Ferrari's. The monitoring variable, whether Pugliese order pricing holds at or above the €550,000 floor, and whether resale premiums on existing Ferrari models hold through the next 12 months.
Lamborghini CEO did not simply cancel the Lanzador EV. He cited Ferrari's fan reaction as the explicit reason the cancellation was correct. This is a sector-level signal, not a footnote. In the luxury supercar segment, Lamborghini and Ferrari are the two reference points. When one competitor observes the other's product launch and accelerates its retreat from EVs, it is expressing a revealed preference about the segment's demand structure. Lamborghini's read is that the existing exotic car buyer base is rejectionist toward full electrification. If that read is correct, Ferrari is not simply facing a communication challenge, it is facing a structural demand mismatch in its core buyer segment. But here is the inversion that most coverage is missing. Ferrari CMO did not deny the fan backlash, he reframed it. The goal is not to satisfy the existing community, the goal is to enlarge it. This means Ferrari is deliberately accepting rejection from legacy holders in exchange for access to a new tier of buyer. Lamborghini's cancellation removes a direct competitor from the EV-based luxury expansion path. If Ferrari's bet is correct and the new buyer cohort does materialize at scale, Lamborghini will have ceded that market by retreating. If Ferrari's bet is wrong and the Luce underperforms on orders, Lamborghini will have avoided a brand-destroying pivot. Neither outcome is yet visible. The Luce does not begin U.S. deliveries until spring 2027. But the competitive framing has shifted in one meaningful way. Ferrari's management stated that the CEO confirmed orders are clocking up despite the backlash. If that order claim is verifiable, delivery allocations, deposit receipts, confirmed waitlist data, it suggests the new buyer cohort is already being accessed. If it is not verifiable by the time the order book closes, it becomes the primary risk. The Lamborghini cancellation also resets the relative value argument. Prior to the Luce, Ferrari and Lamborghini both faced the EV transition together. Now Ferrari credits the full transition risk alone in its segment. That risk is not priced in the current multiple, and it is not resolved by the existing order claims. The verification benchmark set in Chapter 1, whether the brand premium survives the community expansion, will first become observable at Luce's order book close. If resale premiums on existing combustion Ferrari models hold through late 2026 while Luce orders accumulate, the expansion thesis survives. If those resale premiums compress alongside the Luce's arrival, the $5 billion market cap loss already registered is a leading indicator, not the full discount. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.